In this video, we're going to look at life insurance and taxation. And by the end of this video, you're going to be an expert on everything taxes, life insurance. And I have to say, what other video would you want to watch on YouTube? I mean, come on, this is going to be very, very exciting. We got the one and only expert, Dom Rufran, in the house to really break down life insurance and taxation. So overall, Dom, big picture, life insurance is pitched in a lot of cases as this like rich man's Roth, amazing tax haven, the best loophole in the tax code. And I wouldn't necessarily go that far, but as an asset class, there's some incredible tax advantages that life insurance gets. And I want to make sure that we can break that down, understand how it works, and then understand how we can take advantage of the tax benefits of life insurance.
Yeah, and I think it's a great place to start of talking about what gets taxed, what doesn't get taxed, how you can, I won't say avoid taxes, but legally use your dollars without paying the tax man, and essentially the strategies behind it, right? And I think it comes down to first looking at the cash value. So let's start there.
And before jumping into the numbers, because we're going to do that, I want to take a step back and say, like, why is life insurance as a contract have special tax advantages?
Well, I mean, essentially what I was getting at is when we start looking at the numbers, when we start using our dollars, we're taking a loan against our policy, right? And the reason is once you use debt as that vehicle, the IRS has deemed that debt is essentially not taxable. And that's really our strategy at the end of the day when we're using this concept. But there's going to be other times where you won't be using it as debt. And so will we be taxed on that? Should you get taxed on that? Like, what are the strategies? Because there's a lot of them. Like, we're going to go over the basic strategies, but there are other strategies as well when it gets to more advanced, especially business side of things, where you can get taxed as well.
Tom Wheelwright is often quoted for saying, like, think of like the tax code as a treasure map, and they're like the government is essentially incentivizing you what to do, and they're going to give you deductions and credits and benefits if you follow and really help the government, almost like partner with the government. I know there's a lot of people that didn't sit well, but the government wants to incentivize you to do certain things. That's why they give you deductions if you give to charity. That's why if you start real estate, that means the government doesn't have to get into the real estate business. And so they're going to give you benefits to do that. The reason life insurance in general, before we look at the numbers, is such a good tax advantage is if everyone had life insurance in America, we would not have problems, because every generation would have money and they would get more wealthy, and people would be protected, and the government wouldn't have to step in and bail certain people out. And so the government as a whole loves life insurance because they love the death benefit protection. And so it's important that we're going to look at some really incredible tax advantages, but they really stem from the fact that life insurance as a whole is something that the government loves, and no politician on either side of the aisle is going to say, yeah, I'm going to now tax the death benefit of this widow that just lost her husband, or this family that just lost the breadwinner of their house. And so it's important to know that life insurance, yes, has some amazing tax advantages, but at the highest level is one of those products that the government loves because it actually, society and our country is better off for people having life insurance. So with that, anything that you want to say before we jump in?
Yeah, I would also say that people at a very high level, like that have a lot of money, that are essentially the unheards of the unheards, the Rockefellers, the politicians, those types of people, they are huge fans of this as well. And because they have huge power, they're probably behind the scenes saying, hey, like, this is something we want to keep, right? Because a lot of people ask, hey, like, can the death benefit that we're going to refer to, like, can that ever be taxed? Or like, what does that look like? And when it comes to these people, they have a lot of power, including the government. A lot of people in the government are using this as a very powerful tool as well.
And if we look at history, any tax change that does happen in life insurance, people have been grandfathered in. I can't say that, again, this is not tax advice. Don't take anything that we're saying in this video and say, oh, I'm going to actually do this for myself and blame Dom or Caleb. But if you're going to blame one of us, it would be Dom. And so just take that with a grain of salt. But in history, if we can look back at history with any lessons, anything that's been changed, people have been grandfathered in as it relates to life insurance. So with that, we're pulling up an illustration. This is just a basic overfunded policy, putting $50,000 in. You're going to see cash values. You have early cash value, it grows. You have a death benefit, it grows. Purpose of this video is not to talk about the illustration design. It's just to pick a random policy for the example.
Cool. Caleb, I'd love for you to talk about one, like, what is a MEC? And let's start with that. And I think that'll give us a good idea to like carry over into how we can use this cash value, and essentially maybe using that as a structural design too, and just that'll give us a good framework to start off with.
Yeah, so a MEC is what's called a modified endowment contract. And essentially what the government says is if you've put too much money in first year, so back in the day, people were doing like single premium life insurance policies where they would get a big chunk of money, put it in one time, and then there would be a little bit more death benefit up above their cash value. And so it would be very efficient. It would all grow tax-free. And it was like a true loophole for the wealthy to just stick their money in. And the government was like, hey, wait a second. You guys are really taking the advantage of insurance. You're not even getting that much more insurance because the corridor or difference between the insurance death benefit and the cash value is a joke. And so they were like, okay, to get the tax benefits of life insurance, which is once your money's put in, it grows tax deferred, you can use it tax free, and it gets passed on income tax free. To do that, you need to make sure that this is not considered a MEC. You need to make sure that this is actually insurance. Now, what's confusing is every insurance company has different guidelines and how they determine what a MEC is. And so in a lot of cases, they want to make sure that there's some ratio of PUA, term rider, and base. And with that, we're not going to get into the major details there, but just know that the difference between a MEC policy and a non-MEC policy is how, after using the cash value after you contribute, on a MEC policy, there's certain taxes that you have to pay. And anytime above basis, anytime what you use cash above what you've put in, you would have to pay taxes whether you take a loan or you withdraw all that money. And then there could be some other penalties depending on how old you are.
Yeah, so it's safe to say that the way that we design it is hitting it to the max limit to where it is maximizing the cash value, but it's not putting in too much to where it looks like an investment. And the IRS says that's an investment, that's not an insurance. So we want to design this to making sure that it is insurance and it looks like insurance. And so if you hit that MEC limit and you cross it, well, what ends up happening is you do have to pay a 10% penalty if it's before 59.5, and you do have to pay taxes at income level as well. So it kind of just works.
Just the interest above the basis.
Yeah, it just essentially works like a 401k or an IRA or anything like that at the end of the day. So we don't want to use it in that format. We don't want it to MEC, but there are instances where you could MEC a policy and it does make sense. But for the purposes in today's video, we're going to focus on non-MECs, which then leads us into talking about like, well, how can we access our cash value? What are the tax advantages that come with that? So Caleb already shared that one, the policy grows tax deferred, and then we can access the dollars tax free. So when we pull up the illustration, which we're going to do now, we're going to share with you numbers and examples of what that looks like. So if you look at the cumulative column, we're putting in $50,000 a year. Cash value year one is $40,000. At year 5, which is an important number to look at, when we're looking at the break-even point where we have more cash than we have cash that we actually put in the policy, that is our break-even point. The reason why that's important is because we are now starting to look at when we have more money. And that is where Caleb was talking about, where you have to pay taxes on the growth of your policy if you're going to essentially withdraw. So there's 2 strategies that you can do when it comes to life insurance to use your funds. You can take a loan against it, or you can actually withdraw. And so when you take a loan against your policy, what you're doing is you're leaving the cash value intact. You're having your dollar grow for the rest of your life, and you're now able to have your dollars do multiple jobs. Your money will compound, stay with the insurance company and grow, giving you a specific interest rate. You can take that same dollar because it's used as collateral to then go invest and use for a different purpose. That is how we use and we teach people in regards to the and asset is to borrow against to use a loan. There is a controlled cost with that. So to be completely frank, you are going to have to borrow. It's actually borrowing. Think of it as a line of credit to actually get that tax advantage. And that is how loans and lines of credits work, is because the IRS says, okay, that is a debt. We're not going to make you pay taxes on debt. Now, the second strategy is a withdrawal. And that is where Caleb was saying, if you withdraw your funds, you can withdraw up to the basis. And so when I say basis is essentially saying the money that you have contributed. So if we look at an example, let's just go to year 15. Year 15, you have put in $750,000 of your own dollars. Then it has grown to $1,055,846. You can withdraw, actually take out of the policy $750,000 without having to pay any taxes. The other remaining, which is essentially around $300,000, if you wanted to continue to use that money on a withdrawal basis, that is now when you would have to pay taxes at your income level. And so what we'd want to do is continue to take loans against this policy until it made sense to use a strategy where we start to take withdrawals and then borrow against the growth on the policy. And so realistically, we would take loans on the policy really until probably like retirement, until you're older. And then that's when it would make a lot of sense, because what I've actually learned from Caleb, and Caleb may have learned from a lot of experts, is the concept around why would you want to kill the goose that's laying the golden egg, right? The golden egg is essentially the principal that is growing. And once you start pulling money out of the principal and you start deploying it other places, you're now killing the compounding interest. And so we want to leave that goose that is laying the golden egg, which the golden egg is that interest, right? We want to leave that intact to continue to compound and grow, which is why we want to be able to take loans early on. And then later on, when we're older and it doesn't matter as much, we can start deploying that capital from a withdrawal basis to then maximize our actual conversions of the dollars, of how much dollars we can actually use, and then take the difference, which would be the growth on loans basis, so we never have to pay taxes when it comes to this strategy.
Well said. I was ready to jump on you if you made a mistake, and I think you said it perfectly, man. I think overall, maybe rewatch this because there was a lot that Dom said, but overall, the other reason why you wouldn't necessarily want to withdraw, because some people are like, why would I borrow to use my own money? And again, we have other videos. You're not borrowing to use your own money. You're actually, there's benefits of your dollars staying in the policy and you borrowing against. But if you did withdraw, it's actually a mini surrender. And so not only are you not able to ever put that money back into the policy, but there is death benefit that gets permanently surrendered as well when you take that money out. And so there's not an interest charge, which may be when you're older and you want to look at the most efficient way to take your money out. Maybe a withdrawal is better for your situation, but in a lot of cases, a loan creates flexibility on repayments, but also makes it super, super clean and continues to create your and asset to compound every single year. And so anything else that you would want to mention?
Yeah, when Caleb was talking about the withdrawing, a thing to consider as well, within your first like 15 years is the safe side. If you actually withdraw within the first 15 years, the death benefit will go down, like Caleb said, which can actually cause the policy to MEC. So which is why another reason why in the early stages, we want this policy to keep growing and then using the loan function along that way.
So in summary, life insurance, when set up and used properly, you don't get deductions by getting your money put in. In other words, like with certain 401ks and IRAs, you get a tax deduction, which you get to write off your taxes this year. You don't get that with life insurance in most cases. But after tax contributions into life insurance, when set up and used properly, your money will grow without having to pay taxes. You can utilize your money on a tax-free basis. You get to pass it on income tax-free to the next generation. Now, with that, hopefully you can break down some of the estate taxes that people need to know. And then also, if it's not set up and used properly, how other taxes kick in.
Yeah. And so like Caleb was talking about from a deduction standpoint, like let's just talk two quick ways on how it could be deductible. One, the interest that you're borrowing against can be used as a tax deduction, right? Obviously talk to your CPA. That's a conversation you should have. But if you use it for a business purpose or investment purpose and it's documented appropriately, and using even like third-party lenders can really help with the documentation piece of it, you can write that off from a standpoint of just the interest, right? Because that's how loans work. You can write off the loan interest. Another times, if you're a business owner and you want to have executive bonus plans, or you want to contribute to your employees to essentially have a benefit, you can write off that interest as well. Because you're the one paying the premiums and then they're the ones benefiting from it. Typically, if you are the one where you're benefiting from it, the death benefit is in your name, it's not going to be tax deductible. But if somebody else is going to benefit from it and your name is on it, that's a way that you could get tax deductions from that standpoint.
And it is also important to know that your employee or the person that you're getting the deduction for, they don't get all the tax-free benefits that a normal person would get with life insurance. So there usually is a trade-off. And like what you said early on with borrowing against your policy, if you were to have a regular policy and you borrowed against it to buy a car, like, okay, yeah, you get to borrow that money and you don't have to pay income tax on that, but like the interest you don't get to deduct. That would be amazing. But if you use your policy for business purposes, like Dom said, if it's documented properly, you can actually write off the interest, which is incredible. There's a big debate out here, and many people say if you're going to use your policy for business purposes and you want to be like ironclad, make sure that you don't get in trouble with the IRS, use a third-party lender and don't borrow directly from the insurance company. Again, talk to your CPA. There's debates on both sides of the aisle, but many people would agree that the third-party lender is the cleaner way to do it if you're going to deduct the interest for business purposes.
Yeah, we're going to create a whole nother video around that as well. We already have one, but we'll create another one around it. But something we haven't discussed either in this video is talking about the death benefit and how that is taxed, right? And so the death benefit, how is that taxed, Caleb?
It's income tax-free, meaning you never have to pay income taxes on that. But what I'm not saying is it's estate tax free. And in many states and federally, there's an estate tax. And if your estate, meaning when you pass away, if you're leaving more than, it could be 11 million, it could be 20 million, depending on when you die, what year this is in, when you watch this video. So again, make sure you're up on the current estate tax rules. But it doesn't matter whether it's life insurance or you're leaving a house or you're leaving stocks, like that would all count towards your estate. And so you want to make sure that if life insurance and other assets get you over where it would trigger the estate tax, you want to make sure that you're working with someone that can utilize special trust. And again, not tax advice, but an irrevocable trust. Some people call this ILITs. You lose a little bit of control, sometimes a lot of bit of control during your policy. But if your policy is controlled and owned by that trust, and that's in some cases a way to lower your estate taxes, giving you the ability to leave more to your family without paying the government.
Yeah. Caleb said it's not tax advice, but it's also not legal advice either. One or the other.
Remember,
right?
It's Dom. If you have a problem, it's Dom's.
Yeah.
Dom's giving this, not me.
For sure. So to summarize, the death benefit, when you die and pass away and it's going to your beneficiary, that will get passed down to them tax-free as well. Now, if you're a C Corp as well, there's a good chance that you also will get taxed at a certain level in regards to that death benefit as well. So it's really going to just depend on who you are, how it's positioned, how much estate you have. Like there's a lot of different factors in regards to it. There's another thing is when we start looking at like selling your policy, right? When you sell your policy, you're now essentially using it as an investment. So you now have to pay taxes on the growth on that. There's a lot of different characteristics. There's another one actually where if you are a business owner and you have a key employee and you're putting insurance on that key employee, and then you transfer that key employee policy from one employee to the next employee because they left, there's a rider that allows you to do that. And if you do that, you essentially are quote unquote surrendering the policy and putting it on the next employee. And by doing so, you have to also pay taxes on that to transfer it over to the next employee. So there's lots of taxes and strategies and things that you have to be aware of when you're starting to do some of this advanced planning stuff, which is why you obviously want to work with professionals in the space.
We're going to go down a rabbit hole. Okay.
Uh-oh.
We're going to go down a rabbit hole. You opened up a can of worms. So here's what's really cool is what you could do is I could buy a life insurance policy on my dad, meaning I'm the owner. He's the insured. I contribute with the policy. I can utilize the cash value, borrow against. It's all good. And then when my dad dies, that death benefit would get paid to me income tax free. That's where you can own and control another policy and the death benefit gets passed on income tax free. Now, it's because we have insurable interest, and when we designed the policy, I was the owner, he was the insured. So you're totally good there. But there are tons of markets out there of people that have permanent life insurance. Many of these people have universal life policies that are massive at the time, and they're at a place in their life where you're like, I don't want to continue to pay this. So like I have this death benefit. It could be $1 million, it could be $5 million, it could be $10 million. Let's say there's $1 million of cash value. I could cash it out and get $1 million, but I'm like 75 years old or 80 years old, and maybe that wouldn't be the best. And there's a whole market out there where you could sell your death benefit, which is a paper asset that will happen that's not correlated to the market. There's so many investors out there that say, I would love to pay your premium for you, and then when you pass away, I get the death benefit. There's a ton of people that invest in what's called life settlements. Again, insurance companies don't necessarily like people like us talking about this, so we're not telling you to do this. We're just saying like there's a market which tells you there's more value than just the cash value in life insurance. But if you were to be an investor and buy those death benefits as an investment, you forfeit the tax-free nature of that, and the death benefit no longer becomes tax-free to you because of that. So that's two examples of how you can benefit from other people's death benefit. One, you have an insurable interest. One, you don't. That's the difference.
I'm over here kind of chuckling because one, it's not tax advice. Two, it's not legal advice. And three, it's not financial advice either.
Not investment advice. So,
not financial advice.
We just are in hot water, just floating down the hot river.
I mean, that's a good place to start.
Yeah. Hey guys, thank you so much for watching these videos, subscribing. Please leave a comment, your thoughts, your questions. And if you want to learn more about the And Asset and everything life insurance, we have a link down below. It's our And Asset Vault, and it's the best education in this space around whole life insurance, how to overfund. And then we have people that would love to meet with you and talk to you about your personal situation and give you maybe a little bit more custom advice around your situation and what you should do around life insurance.